Okay, it's over to
Okay.
you, Elizabeth. Yeah,
Okay,
okay.
thank you. I think I better off the other one.
Okay, can.
Okay, this is better.
Yep. Mm,
Okay, good afternoon, everyone.
mm,
I'm Elizabeth. Today, I'll share with you my humble experience on how I manage my clients' expectation during market downturn. Okay, it's just around the right time now. This is a little bit of my profile. I think almost the same with all of you. Certified financial planner, FAR, CMSRL license, with a corporate unit trust and PRS consultant by FIMM. I'm a professional engineer by training. I'm IR with Institute of Engineers. And I did my engineering and arts double degree at University of New South Wales, Australia. Okay. Okay, this is KLCI 2002 to 2012. This is the time when I joined the industry, and this is how the market looked like. Okay, so I joined in 2002 in the industry, and as you can see, the market moved down a little bit and then gradually moved up, and it's been smooth sail almost all the time until 2008. So doing business is easy during this time of the year, this period of the year, because every time when the client invests, the market will go up. And then they'll be very happy to see me because their portfolio will be making positive gain. So about 2 years into the industry, I did my CFP course. And that is one of the best thing that I did in my life, that I started the CFP course. So that is one of the foundation where I'm more prepared in the sense when in 2008, just in case you can't see it, so I highlighted it, that we experienced a global financial crisis where the market came down. So by having foundation with financial planning, over the years before 2008, I've been educating my client and going through investment with an objective in mind. Earlier, when we first started, we were trained to do product selling. So product selling as in we sell by the fund performance. So we'll say, oh, this fund is doing very well and the company wants us to promote that. And we will just take the fact sheet and say, oh, by investing in this, you will earn this much. And everybody will be very happy to invest. So as the years goes by, after complete doing financial CFP course, when I meet up with my client, I slowly change the way I approach them. So I'll ask them to have an objective and save for long term and doing regular investment and all that. So that paved the way until 2008. But then when the market came down, it still caught me by surprise. Because of our background, we do not have much information on how the market is moving. When we go to office, everybody is saying dollar cost average because it's very cheap, and the fund manager wants us to do more sales. So the pitch that they're telling us is quite different. But then when the market continue to drop, we start to get worried. Hey, how is the direction of the market? And the client will ask, hey, we don't see the net, positive anymore because they've been seeing positive since 2002. So they're not familiar with the market downtrend, and we were caught off guard and unprepared of what is to come. So 2008 gave me a very big lesson. And I even have clients call me up early in the morning when she read the newspaper and saw the headline, hey, market crash again, what am I to do? And then this lady is doing regular investment, and she's very worried about the market. So then after that period, um, the market start to turn up. So what we do is that we will go through the market cycle. When we see the emotion in client as an agent at that time, we also have that feeling as well. So what do we do? How do we manage our clients' expectation when even our own self will have this type of feelings of market up and down and uncertain? So let's go through the next page and see. So what is client's expectation? Okay. So why does client invest? That's the first thing that we must know. Why do they invest? So if we know why they invest, then we would be able to identify their expectation during market volatility. So at this point, if you could help to let me know or let everybody else know that when you meet up with your client, what are their expectations uh, when they invest? Okay, so now I'm trying to get the chat box out. Would you be able to please put in the chat box what would your client tell you? Yeah, okay, I got the chat box out. What would your client tell you when you first meet them for investment? Okay, we want to make this more interesting. Please do type in your response so that I'm not talking to myself all the time. I key in some of the response that my client gave me. So most people would say they want to make money. Okay, so in the early years, when market is going up, everybody when they think of investment, they think make more money. Okay, and then oh yeah, I see the response coming in already. Yeah, make more money, save money, make money for property down payment. Yeah, save. That's very good. Better return. Yeah, of course, better return. And then some of the people might have might hear say from their friend, oh, now the market is doing very well. Do go into this fund. Don't miss the opportunity. So they go into investment by hearing what their friend said. Oh, I don't want to miss out the herd instinct. And then, education fund. Thanks, Lenny. And some people want a higher return, higher and higher return. Nobody is happy with a low return, right? So when we start to have an objective for our investment, there are other things than just return. There are some meaning behind why we want to invest. For example, education fund, like Danny said, uh, they want to get ready money for the children's higher education. We know that education cost is so expensive, and the inflation in higher education is much higher than our average investment inflation. So we want to start early. We don't want our children to be deprived of an education. So um, having a meaning in investment, we can deliver love to our family. We can care for our family. So the other things, make money for property down payment. Yes, getting more. Invest, let our money work harder for us. Recoup loss from previous investment. Yes, we want to do that too. Okay. And another thing for longer term, we want to achieve our retirement plan. We don't want to work until the day when we kick the bucket. We want to rest at certain time in life. That in order to do that, we must have sufficient reserve to take care of our retirement. Okay, this is what client would expect. And when they are used to the market uptrend, you will see that actually client, when they invest, they will have the mindset that the money will be all well and ends well, and I'll see a beautiful picture with my money growing quickly. So from here, I've enlarged the dates here. So from April 2010 to July 2010, we are seeing more than 15% return in 6 months. And from April 2010 to July 2011, we are seeing more than 40% in 15 months. So is it possible to always see that in our investment return? And that is what everybody wanted to see. Do you think it's possible for us to achieve this type of return? Have you managed to get this type of return for yourself or for your client? 15% in 6 months, or more than 40% in 15 months? I suppose some of you would have, because if you have been in the industry long enough and be daring enough to go into unit trust or into stock market, it is possible. And everybody will be chasing after this when we see more and more return. And a lot of the emotion will come in when we see the return. And the client will be addicted to this type of return. But can we achieve this for our client consistently throughout our career? A bit tough, isn't it? Unless we have a crystal ball that we can identify that this is a uptrend market and this is the lowest, and until certain point in time we want to sell, and that would be the highest, and we capture the maximum return. Okay. Yeah. Agnes, this month close to 40% for gold. Yes, in our industry, we have such a big variety of products that we can access. And that's why I say it is possible. And Sai is saying usually in single fund investment to achieve return in 6 months to 15 months. Yeah, a single fund, we can do that. But how many times can we do that in our career to satisfy our clients' addiction to this type of return? And when they have this type of expectation, they won't take less. If it is less, they'll get upset. So what do we do? Okay. So the reality, oh, sorry. So the reality is the market is not always rosy, and we won't see straight line up all the time. This is KLCI index from 1997 to 2020, total of 23 years. You can see this is the dot-com bubble, and then there's a global financial crisis, and then we are now here. Well, if you put it this way, COVID-19 crisis, hopefully it will come up with a different name. So when we see this, market is like that. It's normal. We never see any part that is straight line up or straight line down or straight line horizontal. It's always moving. If we zoom in, it's much more volatile compared to this line. Let's see how many major drops are there just based on this picture. So the red lines indicates the drop, all the major drop. Not so many, okay? But then again, if you look again, every time when there's a drop, the market will go up. These are the arrow up. The green arrows are there as well. So when we worry about the market volatility, most of the time we worry about the market falling and keep falling, and our portfolio getting more and more negative. And we're not sure what to do when the client keep asking, hey, where is my 15% return? And what happened to my 40% return? So that is the time where you worry. But then the volatility also means when the market come down, it will go up. The green arrow always follow after a red arrow. And we are, if we were to zoom out further into this this chart, we will see more green and red arrows side by side. Of course, sometime in the market, it might move horizontally like this period and this period. But if you look closely, it's not fully horizontal. It's up and down, zigzag all the way, going through time. So When the market were to be with such volatility, are we too worried? Basically, we just have to accept it and see what we can do about it. Okay. So how to set clients' expectation? Okay. So like earlier, what we mentioned, when we started an investment, give the investment a meaning, a purpose, rather than they just want to make money. It's very cold. It doesn't have any life in it. So when we give the investment a meaning, there is life in it. For example, it is education fund for my children. It is a retirement fund for me and my spouse. There is more meaning into that investment. When we have a meaning into something that we do, it helps us achieve what is the ultimate in life. Why we work so hard to earn money? For what? To take care of us and to take care of our loved ones. So when we want to earn money, most of the time, it will ultimately end up being to have to take care of somebody they love. Of course, there are people who just like to make money uh, just for the fun of making money. Uh, but most of the time, there are people in their mind, in their heart, that why they want to do that. So when we identify the meaning and the purpose, um, then this investment is not just a dollar and cents. So we don't know when we want to achieve that, how do we do that? We need to have a time frame. We have an objective set up. We need to have a time frame. And how are we going to achieve that? Whether you're being aggressive person or conservative, or you want to go into gold, go into property, how we want to achieve that. And once it's established, we want to know how much we want to achieve. And then will it achieve, is it sufficient for the purpose that we want to set up for? So once is set up already, we follow through with a plan to help the clients achieve the purpose of the investment. Okay, how to communicate the expectation? Um, when the client want to invest, in their mind is about making more and more money, and as fast as possible, as quick as possible, and as much as possible. But they don't know how much risk that they can take. So some people will want to say, oh, I want 20% return. But in the end, they get sleepless night if they don't, if they see the newspaper headline the next day that say how much the market has dropped. So that is not suitable for this type of client. So to identify how much risk can a client tolerate, we need to go through a risk profile. When we do financial planning, going through personal PFD, personal financial data, it's not easy and it's very time consuming, but it is necessary. Similarly, in investment, going through risk profile is utmost important, especially right at the beginning. It's for the client to understand themselves and for the planner to understand how, how much risk this client can take. So if we don't go through the risk profile, there might be mismatch and the expectation will go haywire. So we are lucky to have the risk profile by FA Advisory. I suppose you're familiar with this page. Not many questions, but by going through this question, we'll be able to know how the client would think. Usually, I will choose to go through this question slowly with the client together. Sometimes they might not understand why do we ask this way. Then I will explain to them what this question is trying to get at. But after that, I will keep quiet and I let the client make the decision on their own which answer they want to choose. So by going through this, if time permits, I will ask some by the way questions. If they're asking about how many months of reserve they have, then I can probe on a little bit more. Why do you write this figure, and what is what is the job nature, how stable it is? A few more other questions. What other commitment do you have? These are some of the by the way questions I will ask so that I get to know the client better. So one of the uh, plus point for our risk profile is that we have this section at the different stage in life. Each client will be able to take a bit more risk, or they must take a little bit less risk. Even though answering the risk profile by having longer time frame, that means younger people, they be able to take on higher risk because time can really average down the risk with the various investment cycle and the increase in the salary and the ability to save more. So these are some of the factors. So for older people, even though with the risk profile they have worked out, we might want to consider a little bit lower risk if they have more, they still have a dependent depending on them, or that they have no more stream of income. So we got to be even more conservative with them. So by going through risk profile slowly and diligently, we'll be able to let the client know themselves a little bit more, and we can help them with a better portfolio or better strategy to help them achieve their objective. Okay. So this is the cycle of market emotions. I suppose you have seen various type of cycle of market emotions. This one I choose because we can see when is the best time to invest, right? When the market is the lowest, the point of maximum financial opportunity is here. And when the market is the highest, the point of maximum financial risk is there. So most people, when they invest, they will ride through the cycle. When the market go up, they have gained more confidence in the market, and they are willing to depart more of the money into the market in the hope to get more, to earn more out of this market uptrend. But nobody know when is the highest, that the tip of the point will bring them to which downtrend and how steep and how long. So when they're having overconfidence during this period, they will be overconfident that when the market is the highest is the time when they put in the most of their money. It's like putting a bet into something. Imagine when we go to Genting and putting in a bet, we put a bet and earn a small amount. We might want to put a little bit more the next time we bet. And when we put
internet audio.
Yeah, when we put more and more into the bet, sometimes when we lose, whatever that we have would be gone in the one bet. Same goes for investment. When this uptrend is there, people will lose their cool, and they forgot about how much risk that they are putting on, whether they can take the risk or not. So greed has blinded us when this happened. So when the market start to downturn, the fear start to kick in. Oh, did I make a right decision? I'm sure the market will go up again because market doesn't come down straight, right? And when the market continue to drop, fear will start to kick in. And then when it go right to the bottom, which we don't know when is the bottom, then people will get depressed. Oh no, I have no more money. How to pay for my children's education? How to pay for my daily meals? So, and I have a client in the 2008 crisis that he shared with me. His colleague um, do margin trading and was sharing with him very happily which stock to go in and what to buy, when he what return he sell and come out. When 08 happened, global financial crisis happened, he took leave for 3 days. He said that friend just sat in the office, don't know what to do, staring at the computer, can't work, heart beating very fast, and when people talk to him, he also cannot answer properly. So these are really real feeling when you have the money in the market. This is how they put too much, they take on too much risk that they can take, and that will affect the physical and mental health when a crisis happens. So after he took 3 days leave, I heard from this client that his friend later on, because he can't work, he take long leave, and then he go and refinance his house or sold his house to pay off to pay off his margin call in the stock market. So cycle of the market can bring out the greed and fear in us. And when the client experience this, do we experience this as well? I'm sure we will, because we feel the market, we are closer to the market than our client. And we want to take care of the well-being of a client, the growth of the portfolio. When it becomes negative, we are worried. During 08, I feel at the one point, I feel I am responsible in the sense, hey, why didn't I do profit taking earlier? What should I do now when the market were to continue to fall? And I start to get worried. And then I think to myself, if the client is entrusting me to invest for them, they are depending on me to help them. If I let myself to follow this market emotion along with them, then who is to help them? So I got to be composed. I got to find out what is happening in the market, how does it affect their portfolio, and if need be, maybe we can't achieve the investment objective, we might have to delay a little bit, or what else can we do? We need to sit down and discuss with the client and to find out what are our options. The worst is if you don't answer calls. Well, because of my exposure in financial planning much earlier before the crisis, I have a certain knowledge in that sense about dollar cost averaging, financial crisis, and emotional, how to manage our own emotion when we deal with our client. So some of the client, as I was going through my course, I will share what I learned with them. When I did the insurance module, I share with them. When I did the investment module, I will share with them. So some of the clients whom are really close with me, they would know, okay, now market is like that. We accept the way it is. So what can we do next? So actually, they do not blame on us of what the market is experiencing. If I can do something about the market, I won't be sitting here. And if if somebody can do something about the market, it won't be a crisis. When there is a crisis, that means everybody is riding the roller coaster down alongside each other, and everybody is experiencing the same. Maybe some people, very few, would be making net a good gain by shorting the market or going into some other alternative investment. But most of the people will ride through the market together because we all feel the same. The market happen not just in one country, it's globally. So when financial crisis happened, I misunderstood that I am responsible for the portfolio performance. When I talk to our client, I quickly get to know that, oh, my client also understand that it is the market that is like that. It is not me that is causing the market to be like that. So when this mentality straighten out, then I feel more confident. I feel more detached to the market downtrend. Then I can, how to say, do more research for our client and help them manage their portfolio more closely. Like just now in the earlier market KLCI index, it won't go down in a straight line. There will be pockets of up and downs. So we work closer with the client to help them recover more of their losses. And then again, when we have a different, various type of investment strategy, we don't invest like punting in the market, like playing in stock market, where we buy this and then we expect 10% tomorrow and then 30%. Probably some of you, if you go in when stock market reached 1,002 a few weeks back, and now you'll be making maybe 20, 30% or even 50% for your stock from your stock purchase. But then in investment, we are not looking at the short-term market gain. We are looking at a portfolio, a long-term investment with an objective to achieve. So we must take on the risk and calculated risk and see how much we can tolerate. Okay, so are you immune to volatility after what's said and done? Volatility, I have taken it as a fact of life in investment, and market trend is, I would say 50% up and 50% down. Of course, when we toss a coin, there is a chance that the coin might stand up. That means it will be like a market moving horizontally, but very few chances like that. So the market either moves up or it will come down, just like the green and red arrow that we saw. So we embrace it, we waltz with the market, we dance along with the volatility. So when we are in tune with the volatility, we can capitalize on the volatility. Volatility is a chance for us to have the opportunity to buy low and sell high. If there's no volatility, what is investment which that is moving horizontally? So volatility is good in a sense where investment is concerned, where we have the opportunity to buy in a discount. Or if there's major crash, it's like a mega sales. So we used to see when shopping malls, they will have mega sales, or Pokong, they have mega sales. Wouldn't we like that? If we have something that we really like and it's so expensive, and when mega sales happen, everybody will rush to buy that. But in the stock market, now what is happening is mega sales is going on. But why aren't we going in? Because of the fear, because of the uncertainty that everybody is holding back. So when client not sure what is happening, they don't know what to do, we must stand out. You must be a little bit more stable and a little bit more calm to help them see, hey, are you aware? Now is the sales time. Please come in. And the sales won't last forever. You see, 1,002 was only for a few days, and now we are 1,003. So whether the 1,002, KLCI index is going to happen again, we might have to wait. So mega sale will come again in the next few months or so. Just wait. But be prepared. So that is how we deal with volatility. We get ourselves immune to volatility, but we stay alert of what is available, what is awaiting with this volatility. So are you still worried about volatility? Are you immune to volatility? There's no jab, but we got to build ourselves inner, how to say, immunology from our own body and mind. So how do I do that? I firstly have the right mindset when I'm facing volatility. So this is the 5 virtues from Confucius theory, 五常. The 5 virtues are 仁义礼智信. I put the pronunciation, 2 is the second tone, 4 is the fourth tone. So 仁义礼智信. So how does this relate to investment? So when the client invests, as we mentioned earlier, they invest with the intention to take care of their loved ones. So there is 仁, benevolence or kindness to their family members or to themselves if they take care of themselves. And for us, when we help them to achieve what they want to achieve, we are being kind to them. So that is 仁. 义 is justice or righteousness. So as a financial planner, we have our work ethic. We have our what we should do and what we should not do. For example, when the client has a low risk profile, are we to recommend to them very high risk fund for the return? That is not appropriate for this type of client. So when the client is experiencing uncertainty about whether they should go in or not, are we to push for them to invest because we want the commission? Or should we look at their situation? Okay, if this is the condition, what should we do? What can we do? Recently, one of my clients just stopped her regular investment. I've been telling her that now the market is in a downtrend. We are buying cheaper and cheaper. But her condition is that the parents in the hometown having some issue with renting the house. So the owner is asking them to move or they buy up the property. So this client is in a dilemma. So she and her sister need to fork out a certain amount at certain date by second half of the year so that they can buy the property so that the parents can continue to stay there. So because of that, she has to stop her regular investment for a few months. So after knowing what is happening, then she was saying, because I will only need this in second half of the year, maybe I just continue to invest because it's getting cheaper and cheaper, isn't it? Then I recommend to her, because we don't know how the market will move. If you were to continue your regular investment now, if the market were to continue down south, when you need the money, you might not have sufficient compared to if you were to put it in a more conservative investment. So she decided to stop her investment for a few months so that she can accumulate enough for the property for her parents to stay. So these are the things that we must decide when we look at the situation of each client, whether we advise them this way is righteous or not. Then the third one, 礼, politeness or courtesy. Well, In our line, we will meet with many clients, and we have all sorts of clients. Some of them very nice, and some of them maybe not so. Or some of them, when they are under stress, they can't take the stress, they will behave otherwise. Well, as a planner, as an advisor, irregardless of how the other party were to behave, we'll have to be composed and continue to be polite, and don't take their emotion uh, upon ourselves. Whatever that happens, how they feel, there must be a reason behind that for them to behave that way. So when we are there to explain to them the portfolio, it might be a trigger point for them to get upset because their investment is now negative 20%. Oh, they need the money. So why is the portfolio like that? And they can throw out their tantrums at us. But when we are aware of what is happening in the market, and we have laid the groundwork with the risk profile and with their objective in mind, we can rest assured that we've done the part. Once we've done our part, we don't have to take on their emotion uh, and to react towards their emotion. We can continue to be courteous to them and try to understand their situation. And the fourth one, 智, intelligence or wisdom. So when we encounter with a lot of obstacles and hindrances and challenges, um, it's very tough. Just like just now, when market were to fall and the client keep calling, oh, what should we do? And we might find it stressful, and we might find it a headache with the government introducing so many schemes, and then we thought we can get back to work already, but then there's 2 more weeks extension in the MCO. So what do we do? Every time when we encounter this type of challenges or hindrances, we get over it. When we are able to jump over the hurdle or solve the issue, we will be a little bit wiser. We will be a little bit more experienced, and with that, we will grow from strength to strength. It's the downturn is the challenges that makes us stronger and makes us wiser and makes us more resilient when the next one were to come. The last one, sing, trust and sincerity. So we won't be here if there's no trust or sincerity. This is a bare minimum in our industry. So if we have mistrust or not sincere, the client, they will know. They now, especially now, when information is so freely available, and when people are so, how to say, they can search of so much information online. They are very well informed. So if there's any mistrust or insincerity, the client would know, and they can sense that. So with this type of mindset, 仁义, 理智性, benevolence, kindness, justice or righteousness, politeness and courtesy, intelligence or wisdom, trust and sincerity. This is the 5 virtues that I always remind myself. And these are the 5 virtues that help me through when the market were to downturn, or when life gets tough. Okay. So after we have our, I have established my own mindset, then I need to find out how to reach out to the client to manage their expectation. First, we need to set clear deliverables. That means if they want to set up a retirement fund at a certain date, can we achieve that? How can we achieve that? When can we achieve that? So be very clear so that they have a peace of mind by doing this, and they will be able to achieve what they set out to do. Be authentic, be genuine in helping them in setting up the portfolio, and try not to have the ulterior motive that the client will be able to feel it. So be genuine in whatever we do, helping them set up their portfolio, helping them plan for their to achieve their objective. Be genuine. Establish regular communication, especially when there's major correction or downtrend. Uh, Regular communication is very important. When time is uncertain, people are unrest. They'll try to look for something to hold on to. It's like a lifeboat in the ocean. When the wave is so big that you have nothing to hold on to, even though you know how to float, you still feel very unsafe. If you can hang on to a float, you will feel much safer. That is the same feeling. So when the market were to fluctuate like that, regular communication is something like a lifeboat for our client. Keep them in the know. Let them know what is happening and what can we do about it. Just by hearing us being there for them, they know we are there, and they know if something were to happen, if they are not sure, they can count on us. So by establishing regular communication, give our client a peace of mind. And then it is good to get to know them personally, and not just an investment topic all the time. When we get to know them, get to know their family, feel with them on their objective and how dear it is that this project is for them, and how is it going to help them? Who are they going to help? Get to know their family, get to know their business, get to know their ups and downs. Then we'll be able to help them better. And it is not just a client, a planner relationship. It will grow into family, close friend relationship. And with that, I have clients whom 3 generations are also my client. One of my clients that I've been servicing, and his father went to the supermarket and met with some lady who introduced them very aggressive funds. So then he come back, oh, my father got conned into this fund. Can you please explain to him? He won't listen to me. Okay, I go and pay them a visit and explain to the father. At that time, he was 70 over, and I'm not sure why the person who sell the old uncle that type of product. After explaining to him, he understand, and then I have another new client, and then now that this client, the children are getting older, and they want them to have a savings habit, and then they introduce me to the children and to help them start their small piggy bank instead of putting in the porcelain piggy bank, but put into investment portfolio where the money can grow, and at the same time they can learn how to invest. It's like an education a path for them in investment. So when we get to know them, we get to know more of their family members, and we know that they treasure our advice. And whenever there is a concern, they will let us know. And with that, we can manage their expectation much easier. So next is set realistic expectation. Well, everybody wants to have 40% in 16 months, right? But we must be realistic. If a person is very conservative, we can't give them aggressive portfolio. Therefore, there is no 40% in 16 months. So the realistic expectation will give client a peace of mind as well as give us a peace of mind. So if we overpromise and we cannot deliver, and our relationship will turn sour. And we all know it's so hard to build rapport and to build a strong relationship, and it can be destroyed by just one mistake or error. So under promise, set realistic expectation, and don't over promise by selling the performance. There's one phrase that we like to use: past performance does not guarantee future returns. That is very true. So don't oversell. Be transparent. Whether the portfolio is making a gain or making a loss, tell them. If the fund is not doing well, we should change fund. Tell them, explain to them. And if this portfolio is falling a little bit short because of the market situation, tell them, explain to them. So be transparent. Whether there is a switching fee, if you ask them to switch, whether this fund is too high risk for them, or this fund there are other alternatives, tell them. So be transparent and be honest. Whatever we say must be true, because when a lie was laid out, it will grow, it will balloon, and we can't stop it from growing. So be honest. In our industry, that is our golden rule. So what do we do? Keep cool, stay calm. We just need to be a little bit more cool than our client when the market were to downtrend. And when the market were to, when the client were to call us with a very excited voice, oh, what to do? The market came down again. We must answer to them with a stable and clear voice, rather than we say, oh no, I also don't know what to do. So we must stay calm and we keep cool, just a little bit more than what our client is feeling. So how do we do that? How to keep cool? Yeah, we have a solution. I like to use regular savings plan, and I find it works. So probably you all would have heard before regular savings plan. It is a fixed invest a fixed amount of money on a regular basis for a long period of time, and regular investment, and we will invest regularly regardless of market condition. When we get into the habit of savings and investing regularly, and we can grow our net worth steadily over time. So when we invest a fixed amount of money over a long period of time, so the amount that we want to achieve, we can split it out over many, many tranches. So we won't be burdened by a big amount when we really need the money. And on a regular basis, because we tend to forget, it's very easy to forget. So when we set out regular investment, we don't have this worry. We know, rest assured, that our money is invested and is exposed to the market according to our risk profile. So we don't have to worry about the market uptrend or downtrend. And when the market is lower, yeah, discount is here. Buy a little bit more, top up a little bit more. And then we get into the habit of saving. This is really character building. When we have a habit of saving, we're doing it regularly. We're building our character to be consistent, persistent. We have our calmness, irregardless of the market condition. We'll be able to ride through. We have confidence. So by doing regular investment, regular savings does build our character. All these hidden values that we can see out of just simple regular savings plan. And of course, our net worth will grow steadily. Really, sikit sikit jadi bukit is true. It's really true. Stay calm with RSP takes out our emotion factors and create discipline, thus improve the returns. Because emotion can really help us to make the wrong decision at the wrong time. So we always like to say we buy low and sell high, but like just now the emotion cycle, most of the time we tend to buy high and sell low, and we are not aware of that. We just let our emotion uh, uh, pull us along. But when we do regular savings plan, we take out the emotional factor. And I will show my client with regular savings plan how by doing regular investment, it will reduce the cost per unit in their investment. And then every time when they buy, I will show them, okay, you buy at this time, let's say it's 1 ringgit, and later on it came down to to 90 cents and came down to 80 cents. Look at how much units that you have accumulated. And when there's a distribution, you don't have to pay a cent, and then your units has increased. So when market were to go up, I will show them the number of units might multiply by the market value, the net asset value, the how much they would have got they will, if they were to sell. So when we take out the emotional factors, market up or down, we continue to invest, we will have a much more stable and well-structured investment. Well, this is one of the way to do that. And then it can smoothen the volatility of the market by buying more when prices are low. So if 1 ringgit down become 50 cents, mega sales again, and then the cost per unit become lower, and then the volatility in the portfolio that we are buying would be reduced. And it saves time. Avoid mistiming the market, as mentioned earlier. Okay, how regular investment works. This is thanks to IFAS. I've extracted from one of their presentation to highlight how regular investment works. So in this chart, probably you've seen before, here is the number of years, horizontal bar, and the vertical bar is the amount of investment, amount invested. Let's say this person starts now, year 1, which is the blue line, starts in year 1. Invest regularly, 5,000 per annum. Over the years, this would be the amount that they have accumulated, 204,000, well, assuming 7% growth per annum in that investment. This is the amount that they will have accumulated. And if this person were to invest 5 years later, so now it's not the right time, they worry about the market or financially not prepared yet, they start 5 years later. Similarly, 5,000 per month, and over the same period until year 20, the amount that they would have accumulated at 7% per annum is 125,000 over. So the difference is 79,000. So this chart goes to show the cost of procrastination. If we don't start soon, we miss out the opportunity here, and we miss out the number of investment that we can accumulate in the earlier years. And where regular investment is concerned, the earlier years, we can't see much because of the upfront fees that we see, because maybe we're buying more expensive and we average down the cost per unit a bit later. For the first 5 years, we won't be able to see much. But 5 years onwards, from my experience, we'll be able to see the portfolio growing faster than the average fund performance. Well, if we were to start 5 years later, that means the growing part is 5 years until here, that means the growth will start to try to catch up from the 10-year onwards. So for this chart, a few things we can get out. Regular investment does work. This 5,000 per annum can make us 204,000, almost 205,000 in 20 years' time. And we start as soon as possible, as soon as when we are aware of the importance of investment, and as soon as we want to capitalize on the market, as soon as we want to achieve our goals. Just start. When we are not in the market, we don't know how it is. It's only when we are in the market, then we feel the market, because money is there. We feel the pinch, we feel the happiness when we make a gain, and we learn with our portfolio. So if you were to procrastinate, the cost is hefty. Just 5 years. The difference is almost 80,000. So for regular investment, start as soon as possible, start regularly, consistently, and over the period, you will reap your result. Well, we also need to know, some people, they don't like regular savings, they like lump sum investment. And we have clients who like to compare. I invest this time and now I can get higher than the regular investment plan. So your regular investment plan is not good. But, well, it is a different type of investment. So from here, I'm trying to illustrate how the difference is. So I'm using IPAS table again, see if we can make it clearer. Okay, regular investment plan, the blue color one, from first year, invest 250,000 a month, assuming 6% return. And over the years, we would have accumulated 32,000 by this way of investment. And if you were to put in one lump sum, 24,000 upfront, and growing at the 6% per annum, over the years, we would have got 42,000. The difference is 10,000. Then your client would say, your regular investment is growing much slower. My way of investment is better. Well, don't have to, we can't compare in this way, because what if when your 24,000 were to go in when the market is very high, then your lump sum investment would make a major loss. What if the lump sum investment were to go in and the return, how to say, when the return is a certain amount, and that is only the amount that you have. When we continue to grow, you see these two charts will merge at a certain point in time. The regular investment, even though it's 250 a month, we can't compare to 24,000. Over the years, the investment amount will grow. And if this chart were to continue, at a certain point in time, the blue chart will go surpass the green chart. Well, this is to give you more confidence on regular investment, and we can't really compare to lump sum investment per se. And of course, if they want to compare, lump sum investment at certain point in the market, of course, will do much better than regular investment. But there is a different purpose in regular investment. Okay, we want to cultivate all the good habits that we have. We don't want to time the market. We don't want all the stress of the market up and down to worry us. So that is a different objective. And when you put in a big sum at the one time, you might be more worried if the market were to move up or down. There will be more how to say, concern if the market were to drop. Well, this is an ideal case where the market go up, and client will compare in this way. But then rest assured, regular savings plan works for portfolio. Okay, so when I introduce regular savings plan to my client, I would usually let them know, like I mentioned earlier, first 5 years, you won't be able to see much of a return. And you must consistently invest more than 5 years, then you will start to see more return. And if the irregular investment amount is small, I would not diversify into too many portfolios. But if the amount is big, it is worthwhile to consider a few funds and set up a portfolio for the client to invest, to diversify away into different type of funds. And over the years, for smaller amount, I will let it grow because we have an objective there and we want to let the fund snowball. And if we were to do switching here and there, we might not see the full effect of the dollar cost averaging effect. Having said that, I would still look in the portfolio if it's been quite a number of years. For example, in this portfolio, after so many months, I've accumulated 32,000, and now is 2020, and the market is in a verge of downtrend, and they still continue to invest 250 a month. I wouldn't stop that. I would consider to profit take a little bit from here for a short while to avoid the market downtrend. And if the market were to go up, I would regularly channel this amount back into the fund again to help them enhance their dollar cost averaging effect. This I will do. And for uptrend market, well, uptrend market, everybody is happy. We don't have to worry about that. Just ask them to invest more. Maybe if they are confident with the market, they will put in a bit more. Bear in mind the objective of the client. We don't want to, how to say, because of the market performance, we let the client go into something that is outside their risk profile. So I want to share with you one of my clients in earlier time of my career, and she is a very conservative investor, investing in mostly the bond fund and money market fund. And as you recall, the market is all the way up until 2008. So when I see other clients' portfolio doing so well, and I recommend to this client, why not you consider one of the funds that is moving faster, just like what our portfolio, Sunny would say, core and satellite. But for this client, she is very conservative investor and she don't really understand about market that much. But then because of my explanation and the track record of what other portfolio is doing, she said, okay, we put some amount, I think it's less than 10% into aggressive funds. But then not too long after that, maybe not too long, it's maybe about 1 year plus, the market crashed. It's 0.8. And the 10% of the portfolio left with only 5%. And that is not a main issue because her bond part has gained sufficiently to cover that. But the thing is, in this client mind, the 5% drop is as big as a Ferris wheel. She can't sleep. She keep calling me every time when she see me. Oh no, this is very bad, and I'm losing a lot of money, despite what I explained and how it is that the market will go up and the bond part is still growing. It's not affecting her objective to achieve her objective, but she cannot take it. So from this lesson, I learned that if a client is conservative, we leave them be. If they can take on a little bit risk, we can help them to include a little bit of satellite funds or satellite product to help them enhance their return. But if they really cannot take it, just leave them be. It is not worth it to try to give them a little bit more in the return in exchange for the anxiety and sleepless night. So from there, since then, her portfolio is still achieve her objective, and that fund that has went down to about 50% of the performance, it came up, and it took quite a long time. And I did help her to recover the 5% loss that she has got from that experience. So sometimes we need to really talk to the client to understand before we do any type of recommendation. And once our plan is established, especially in financial planning, we go through the 6 steps financial process. Stick to that. And if we really need to change, we must have black and white or written consent, and to let them be aware of the risk, that what the upside is there and the downside is 50% chance of happening, and it could be there too. So most of the people, when we talk about investment, they talk more about the upside, forgetting about the downside. And it is the downside that we must let them know as well. Oh, I've talked so much. Do you have any question? Let's quickly finish. And keep clients' objective at heart and keep abreast of market. When we keep the client's objective at heart, we don't go astray. We don't be overcome